Welcome back to Fast Market on the TD Ameritrade Network. Let's take a look at the four major indices before we get into our next segment here. We've got the NASDAQ actually moving up off of lows, now up about 0.1% above. Actually, I think it's about 0.4. That might be stagnant right there because the Dow Jones Industrial Average is up about 1.93%. The S&P 500 up 1.2% on the day, and the Russell 2000 up 1.75% on the day. I think that NASDAQ a little bit laggard because I got the NDX up 0.46% on the session. But joining my co-host Kevin Hinks and I will be Andy Swan, the co-founder of LikeFolio.com. Thanks for joining us, Andy.
Hey, good to be here.
All right, so we've got AutoZone. We got to get in the zone here. They got earnings tomorrow morning ahead of the open. This stock's up about 58% in the year, but the whole auto parts segment, a lot of these stocks are up over 35, 40% so far this year, just off all-time highs. What kind of data are you seeing on AutoZone in this sector?
Well, really, it is a sector-wide kind of thing. There's these enormous macro trends that have kind of taken over this industry, and if you think about it, it just really makes sense. I don't know if either of you have been shopping for a used car lately, but it's an unbelievable marketplace. We went shopping the other day for my daughter, and essentially the lot just told you, hey, you might as well just buy a new one because it's almost the same price to buy one that's 1 or 2 or 3 years old as it is to buy a new one because there's such a shortage of these vehicles. Now, what happens when that kind of thing happens is, you don't have access to buy the used car, to buy the new car. You're much more likely to deal with the car that you have. Instead of upgrading, you're much more likely to simply fix the one that you have. And I think that's what's happening all across this industry. For AutoZone specifically, our data really leans on that do-it-yourself customer. And while we saw, that 2020 stimulus check-driven demand go very high and then kind of taper off earlier in 2021, what this used car market has done is revived the segment. And so we actually see do-it-yourself home or auto improvement through AutoZone flipping to positive. The demand is flipped to positive for the first time this quarter. It was a pretty low bar to get over, but they did get over it. And so we think there's at least some reason for these companies, and especially AutoZone, because like you can see, easily the biggest of the bunch in terms of the number of people talking about doing it yourself through one of these companies. All of these companies are benefiting from the fact that used cars and new cars are so expensive and so hard to come by that really everybody's somewhat forced to fix it themselves and walk into an AutoZone to get it done.
Andy, you're right. This market, this sector of the economy has been completely disrupted and turned on its head. The question is, for companies like AutoZone, I have two questions really. Number one, is this the peak for that? I know auto dealers in my area outside Chicago, and they're saying they're starting to get cars in. Not 100% of what they're doing. They're getting about 25% of the cars they were getting, but slowly but surely, semiconductors are starting to get to dealers. Dealers are starting to get cars and sell them. So the first question is, for a company like AutoZone, should we be thinking about this as the peak of do-it-yourself and this phenomenon that you talked about? And then your second chart looks like it has a couple of the smaller companies like O'Reilly gaining on AutoZone. So are they getting macroeconomic pressures possibly and micro from competitors? Is this a time maybe to be careful about a stock like AutoZone?
Yeah, I do think it's time to be careful because you're right. There's only so long that used car prices can be equal to new car prices. It's a market disconnect. Those rarely last for very long. But at the same time, if I've learned anything over the last 18 months, it's that when you expect something to not last very long, that's inconvenient or a disruption, there's a real chance it could continue to last for a very long time. And so I don't like to try to call the tops of these disruptions any longer. So I think your question is going to be the first question that analysts and investors are asking of the executives on these calls. But I do think that your second question is more valuable to the longer term investor, and that is AutoZone losing some of its cachet? Is it losing some of its business to these other competitors like O'Reilly and others? And I'd say the answer is clearly yes from our data. This latest surge has benefited customers or competitors more than it has AutoZone, and so that's something to be concerned about as well. Because when things do revert back to normal, where are those customers going to go? There's going to be a smaller pie to choose from, and if they're going to competitors, that's not good long term for AutoZone.
And one of the things I kind of wanted to, ask you about, Andy, as far as the data goes, because one of the key things I think people are forgetting about is the number of miles driven by people is really starting to ramp up. I mean, traffic in Chicago is about the same as it was in 2019 at this point. It's ridiculous, even though nobody's going down to their office. It takes me the same amount of time to get anywhere because people are out and driving more miles. And that's going to most likely equate to the fact that people probably have to fix their car in some regard, right? As those miles driven speed up. And if you can't find a new car, you're probably going to fix up the one you have. Do you have data that supports that, where maybe, if the chip shortage starts to wane a little bit and auto production continues to rise in meeting demand, that, hey, you're still going to need AutoZone and these others in the space?
Yeah, I think so. I think there's something to be said for an increase in miles driven. It's clearly happening. And also I think, not to contradict my earlier point, but used auto sales are also good for AutoZone, because when you get a new car to you that's used, there are improvements generally that people want to make to those, and that sparks something. Like when you buy a new house, that sometimes sparks a trip to Home Depot or Lowe's. You buy a used car, it can spark a trip to AutoZone. So I think there's multiple factors here. I think that they're in pretty good shape. But again, this is all coming off of a pretty low bar, because what happened in 2020 is very difficult to replicate. So the fact that they're getting, at least in LikeFolio data's world, some improvement on those levels that we saw a year ago is a positive sign, because this time they don't need stimulus checks to do it. And I think that's a big deal. But how long can it last? Kevin's question is really the pertinent one. I'm just not sure. I'm not sold on this company at all long term, especially with the competitive pressures it's facing.
Kev, did you have a follow-up for Andy on this one?
Well, I just want to, now here's one last thing, and it's kind of a measurement, like a weights and measures question. Because you have, AutoZone up 8% in your change of purchase intent, but they're dominant in terms of their total volume compare, right, in your first graph. So is plus 8% actually bigger than O'Reilly's up 35% in terms of real numbers? Because up 8%, it looks like it's at least 3 or 4 times the size of O'Reilly's. Or are you just comparing apples to apples there? Because it looks like, hey, listen, if I'm AutoZone and I'm up 8%, that might be bigger than O'Reilly up 35%.
Yeah, it is. It might be bigger, but the problem is, if there's an increase in demand and it's being spread evenly among competitors that weren't previously spread evenly, then that means that AutoZone's market share is declining. And I think when you've got an impetus like they have right now, more people walking into the store because they have to fix their car, that's an opportunity for competitors to really shine and to earn that customer for life. And so you would, if you're AutoZone, the fact that you're bigger isn't an excuse. You want the same growth rate as your competitors, and they're not getting it. So I think that's a negative in terms of that initial experience consumers are having with these companies during a high demand, during a macro-driven high demand time.
All right, great stuff as always. Hey, Andy, real quick, what kind of earnings rating do you guys have on this? Because you've got positive data on all of them, basically.
Yeah, I think it's moderately bullish, but again, long term, Kevin's question is the big one, and how executives answer that may be far more important than the revenue data or the earnings data that the company prints on the sheet.
All right. Have to look for that guidance and have to look for what they're expecting moving forward as we come out of this pandemic. All right, Andy, great stuff as always. Thank you.
Thank you.
All right, that's Andy Swan, the co-founder of LikeFolio.com.